When interest rates fall, the rules of money don't just change, they flip. What once felt heavy suddenly feels light. What once felt locked suddenly starts to move. Opportunities that looked impossible yesterday suddenly open wide today. But here's the truth most people never see. The rich don't wait for interest rates to drop. They prepare for them. Because when the moment comes, hesitation is costly. By the time most people are still reading the headlines, the wealthy are already making moves, setting deals, and turning cheap money into long-term power. This is the difference between watching history happen and quietly building wealth from it. For most people, interest rates are just numbers they hear on the evening news. A percentage flashed on the screen, a headline about the Fed, something that feels distant, abstract, almost irrelevant to their daily lives. But for the wealthy, interest rates aren't background noise. They are signals, signals that tell them when to borrow, when to buy, and when to expand. When rates are high, money is expensive. Loans eat into profits. Credit cards drain wallets faster. Mortgages tighten household budgets. So average people slow down, cutting back, waiting for better days. But when rates drop, it's like oxygen rushing back into the system. Businesses breathe easier. Markets rally with energy. Investors who were sitting still start running again. Here's the catch. By the time the average person notices, it's already too late. The wealthy didn't wait for CNBC to confirm Powell's speech or for a bank to update its flyers. They were preparing while everyone else was distracted. This is where the silent gap widens. Because when rates fall, one group celebrates shaving a few dollars off their credit card bill, while the other group locks in million-dollar real estate deals, refinances entire portfolios, and scales investments that will pay for decades. That difference doesn't come from luck. It comes from seeing what others don't. When interest rates fall, the first effect is invisible. You don't notice it at the grocery store. You don't feel it in your paycheck. But on Wall Street and in global markets, the reaction is instant. Stocks surge as investors flood back in. Crypto lights up with sudden rallies. Housing demand starts to heat up as borrowing becomes easier. Why? Because cheap money fuels risk. If borrowing costs less, businesses suddenly expand. They hire faster. They launch new projects. And investors feel safer pouring money into assets that once seemed too risky. Think of it like gravity. When rates are high, gravity pulls harder. Every financial step feels heavy, like running uphill with weights tied to your legs. But when rates fall, gravity loosens. Suddenly you're lighter, faster, and every step covers more ground than before. The wealthy know this better than anyone. That's why they don't just watch the markets during these windows. They prepare to strike. They refinance real estate at lower costs. They borrow capital cheaply to grow businesses. They reposition portfolios into higher growth plays before the crowd rushes in. By the time the average person is still scrolling through news headlines, wondering what it means, the wealthy are already halfway down the track, letting momentum push them further ahead. That is why interest rate cuts widen the wealth gap. Not because the system is unfair, but because those who are ready move before those who hesitate. The truth is, wealth isn't built when the rates actually fall. It's built in the silence before, in the months, sometimes years, of preparation that nobody notices. Picture two farmers. One plants seeds before the rain. The other waits until the storm is already pouring. Both will see growth, but only one will enjoy a harvest that truly multiplies. That's exactly how the wealthy treat interest rates. They don't guess, they prepare. When rates are high, most people pull back, complain about the cost of loans, and stop planning ahead. The rich, on the other hand, are building dry powder, cash reserves they can unleash at the perfect time. They're also strengthening their credit while others ignore theirs, paying down balances, polishing their financial resume so that when banks loosen their grip, they're the first ones approved for cheap capital. And they're scouting opportunities. They study which neighborhoods will boom once mortgages get cheaper. They track which companies will scale fastest when expansion costs drop. They watch which asset classes will light up the moment the Fed pivots. It's a quiet kind of patience, but strategic waiting. Because when rates finally do fall, they don't waste a single second asking, "What should I do?" They already know. They already have targets. They already have lenders lined up. And here's the hidden advantage. Banks prefer lending to people who look stable, strong credit, healthy reserves, clean balance sheets. So when the window opens, the wealthy don't just borrow, they borrow bigger, cheaper, and faster than anyone else. By the time the average person is celebrating a slightly lower mortgage payment, the rich are locking in deals that will pay them every year for the next 20 or 30. Now, you might be thinking, that's great for billionaires and hedge funds, but what about me? The truth is, the same playbook works at any level, just scaled down. Because interest rate cuts don't only change the game for Wall Street, they can transform your personal finances too, if you're ready. Start with debt. When interest rates fall, the very first opportunity is to refinance or pay down expensive loans. A credit card charging 20% interest may suddenly fall to 15%. That difference might seem small, but it's the equivalent of giving yourself a raise without working more hours. Next, look at your credit. While rates are high, you should be strengthening it, paying on time, lowering balances, avoiding new unnecessary debt. Why? Because when banks open their doors wider, they don't lend equally to everyone. They lend first to those who look reliable. Think of it as polishing your resume before a big job opening. Then consider cash. The rich build cash reserves not because they're scared, but because they're hunters waiting for the right season. For you, it doesn't have to be millions. Even a few $1,000s set aside in advance can mean the difference between watching opportunities pass you by or grabbing them when they appear. And finally, think about assets. When money becomes cheaper, risk assets, stocks, crypto, even real estate often surge. This doesn't mean you gamble recklessly. It means you position carefully, step by step, so that when the tailwind comes, it carries you forward instead of leaving you behind. Because here's the secret. You don't need to be a millionaire to play this game. You just need to act like the wealthy act, preparing before the moment, not after it. When interest rates drop, there are 3 levers that matter most. The wealthy pull them every time, and you can too. 1. Offense. Increase the flow. In cheap money makes expansion easier. For the wealthy, that means launching new ventures, buying companies, or scaling investments with borrowed capital that now costs less. For you, it can mean doubling down on skills while credit is cheaper. Taking a course financed at lower interest, starting a side business with small borrowed capital, or even renegotiating your salary while companies are more confident in hiring. Think of it as opening a faucet. The wider it opens during these windows, the faster your wealth fills the tank. 2. Defense. Lock in your gains. Falling rates are the perfect time to protect your foundation. Refinance debt that once felt crushing. Take a 7% car loan down to 4% or a 6% mortgage down to 3%. Each percentage point saved isn't just relief, it's momentum you can redirect into savings and investments. This is where most people miss out. They celebrate lower payments, but they don't channel the difference into growth. Defense isn't just about spending less, it's about redirecting what you save to strengthen your system. 3. Efficiency. Put your money to work. This is where the true acceleration happens. As markets heat up, every dollar you invest becomes more powerful. But efficiency means being intentional, using low-cost index funds, moving your emergency fund to a high-yield account, automating transfers the second your paycheck lands. And don't underestimate automation. Humans hesitate. Systems don't. Efficiency ensures that cheap money isn't wasted. It's captured and multiplied. Put these 3 levers together, offense, defense, efficiency, and you stop just surviving interest rate shifts. You begin to profit from them, turning what looks like small changes into long-term compounding advantages. At first, preparing for lower interest rates feels boring. You're saving when nobody else is. You're paying down debt while friends are buying new cars. You're building cash reserves in silence, and it feels like nothing is happening. But then the shift comes. The Fed announces a cut. Rates slide down. And suddenly, the math flips in your favor. Picture yourself climbing a steep hill with a backpack full of bricks. That's what money feels like when rates are high. Every step is slow, painful, exhausting. But when rates fall, it's as if someone takes half the bricks out of your pack or even tilts the hill downward. The climb that once felt impossible suddenly feels lighter. Your same effort now produces twice the distance. That's why markets rally so quickly. Stocks don't wait. Housing doesn't wait. Crypto doesn't wait. They all accelerate the moment the slope changes. The wealthy know this moment is coming. That's why they don't scramble when it happens. They've already packed their parachutes and are ready to glide while others are still tying their shoes. And here's where compounding comes alive. Lower rates mean lower costs. Lower costs mean stronger cash flow. Stronger cash flow means bigger reinvestments. And bigger reinvestments mean the curve bends upward, faster, steeper, and with a momentum that feeds on itself. It's not luck. It's not magic. It's preparation meeting timing. And once you feel that shift, you realize you're no longer just climbing, and you're accelerating downhill. When interest rates fall, the numbers change first, but soon after, your mindset begins to shift. For most people, lower rates just mean cheaper debt, a slightly smaller credit card payment, a little relief on the mortgage. They treat it like a small discount at the checkout line, but for the wealthy, it feels like freedom. Because suddenly they're not asking, how can I survive this economy? They're asking, how can I expand in this economy? That single shift from survival to expansion is everything. You stop seeing money as something to cling to and start seeing it as a lever, a multiplier, a tool that can push your life forward when positioned correctly. A loan isn't just a burden anymore. It becomes leverage, a way to buy assets that grow faster than the interest you owe. An investment isn't just a risk anymore. It's a worker that's finally running at full speed because the wind is now at its back. And here's the powerful part. Once you've experienced this mindset shift, you can't go back. It changes your lens permanently. You begin noticing opportunities where others see noise. A dip in the housing market looks like an entry point, not a threat. A small rate cut looks like the spark of a bigger rally. You start asking, is this decision moving me forward, or am I wasting the chance? Am I letting fear slow me down while others are speeding ahead? That's why the rich get richer when rates drop. Not just because they have more capital, but because they already have the clarity, the mental readiness, and the courage to act while everyone else hesitates. Here's the truth most people miss. Lower interest rates don't magically make anyone rich. They simply tilt the playing field. They remove the weight, reduce the cost of money, and speed up the flow of capital. But whether that flow works for you or passes you by depends entirely on how prepared you are. For the unprepared, falling rates just mean shaving a few dollars off a car loan, maybe saving a little on a credit card. It feels nice in the short term, but it doesn't transform their future. For the wealthy, the same drop in rates means something very different. It means refinancing entire portfolios, securing leverage on properties that will cash flow for decades, and positioning millions in assets that compound faster than before. It means decades of returns launched in a single decision. The difference isn't luck. It isn't unfair access. It's readiness. Because when the system loosens, it doesn't hand out wealth. It hands out opportunities. And the people who are ready, with cash set aside, with credit strong, with strategies in place, are the ones who capture them. Think of it like a race. The starting gun fires, but not everyone is wearing running shoes. Some are barefoot, unprepared, and already behind before they take the first step. Meanwhile, the wealthy are at the front of the track, trained, equipped, and sprinting the moment the signal comes. So the real question isn't, will rates fall? The real question is, when they do, will I be ready to act? That's the mindset shift. Stop treating interest rate cuts as background noise. Start treating them as one of the most powerful wealth signals you'll ever receive. When interest rates drop, most people see relief. The wealthy see acceleration. And you have the same choice. You can treat it as just another headline on the news. Or you can treat it as the green light that changes everything. Because every shift in rates creates two groups of people. One that saves a few dollars and feels temporary relief, and another that uses the moment to build lasting freedom. Every dollar you position today is a worker waiting for its chance. And when the slope tilts, those workers don't crawl, they sprint, they multiply. They build on top of each other until the system itself is carrying you forward. So don't wait for the news to tell you it's time. Prepare now. Build your reserves. Sharpen your defense. Design your system so that when the moment comes, you're not reacting. You're already moving. Because when the window opens, it won't stay open forever. And the wealth will flow to those who were ready, not to those who hesitated. If this video helped you see the game differently, hit like, subscribe, and share it with someone who needs this mindset shift. And remember, every dollar you prepare today is a silent worker waiting to sprint the moment the signal comes. It never calls in sick. It never asks for a raise. It never clocks out. It just keeps building your future. And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth forever.